this mind space in India is dominated by targets. 175 gigawatt by 2022 is known to pretty much all of us. As you know, we're closer to a third, less, in the order of a third of that right now, and 5 years are left. Instead of targets, one of the things that we've asked about is, what are the frameworks to making it happen? So when we say, is there enough money? Well, there's always enough money if it makes sense, globally, capitally speaking. So are the frameworks right is really one of the tough questions. One of the findings, and these are parts of studies that will be coming out shortly from Brookings and Brookings DC jointly, is systems level thinking about renewables. Because much of renewables today has been focused on the L1, which is the levelized cost of energy, cheap as possible. I mean, I'm sure people have been watching with surprise at the price falls, Badla being a record, then it crept up a little bit. But people were not as expecting wind to also find such a dramatic decrease so suddenly when it moved from a feed-in tariff towards the bidding norms. So some commentators have asked this question, is this a race to the bottom? So there's the viability side that we may talk about. There's the side that you are dependent on imports, specifically Chinese imports, and in the last few months those panel prices have firmed up a little bit. So whether they've firmed up isn't the issue, it's more, is this trend that we're expecting and basing entire models on going to continue over 3, 5, 7, 10 years? Jury's out. The same question could in fact be asked about one more enabling technology, which is batteries. Because we've been doing some analysis, and what it points to is, in the near mid-future, which means the next 10 plus years, we don't foresee peak coal. There's people who are saying peak coal is upon us, it's just a matter of time. If you do the math, depending on assumptions, so the first caveat that any scholar will make is, well, it depends on this, and then you hedge yourself against all these problems. But if we just do a back of the envelope and say, India has 2 targets, one well-known, 175. Now 2030, it's not clear what an articulated RE target is. 350 is one number that Arvind Subramaniam, for example, used in his talk, and a number of people have used, but there's more fuzziness in the second half. So that's one of the things. Now, first observation you will see is, if you're growing so quickly to 175 in a shorter time span, then in 8 years, do you only double? So what does that mean? Is it that you may not meet the 175, it'll come later, but meet the 350? Or does it mean that you're going to hit saturation effects? It's easier to put in this smaller, medium, large amount, but the enormous amount that people are talking about, to the point where you no longer need coal, that's sort of one of your backstops, that may actually get tougher. And so a very back of the envelope way to look at it is twofold. One is not look at capacity, but energy, because that's one of the problems in a lot of planning. Because the plant load factor of renewables, as you know, is about 20, little higher for wind, 21, 22 over in aggregate, while a thermal plant could or should be, forget 60%, but ideally 70+% load factor. So adding 300 more of renewables is equivalent to adding 100 of coal on an energy output basis. So in the next 13 years, using 2030 as a benchmark, India's expected electricity demand is going to be more than an addition of 50% of where it is, or 30%. So that just means even if you meet the government targets, it's not enough. The second challenge is the time of day, because as we know, solar is available in the middle of the day. So to meet it at the off-peak periods, if you're truly displacing coal, you're reliant on a battery, and those economics are also out. So there's some modeling that'll be coming out very shortly on why and how we may or may not, more likely, hit peak coal in the coming decade. So RE's had some hiccups in the last few months. Forget prices, bids, even globally, RE has seen this. And another sort of question that I'll throw out there and then look forward to your opening remarks is obviously on finance. Is that the bottleneck? Is that the enabler? Is that the tail wagging the dog? Because there's a lot of money chasing it based on targets, but the bottom-up ability to absorb that RE, that feedback loop, hasn't necessarily closed. This is why we're seeing the RE excitement shifting along India. It started with the southern states, western, and they've sort of said, thank you very much, I'm full. no more PPAs for you. So then you have other states in India which have been the leaders. But will they also reach a plateau somewhat quickly is a million billion rupee sort of question. And then the last sort of point that I have in my opening sort of thoughts, and then there's more, is on the split between different technologies, grid and rooftop. So if I could ask David to just sort of take a higher level view before we dig into India and just talk about what's happening with renewables worldwide with that perspective. What's reals, what's prices? Because you look at the US, they have very cheap interest rates. There's an investment tax credit, and yet we're expecting renewables in India to be cheaper than the United States. How does that work?
Yeah, and the United States market may be about to see a series of very big changes. We're undergoing a process of tax reform right now that might in various ways implicate the US market. The capacity of the United States to adopt dumb policies is infinite, and we're about to adopt a dumb policy around tariffs on imported solar, and that's going to make it more expensive in the United States. So I hope India does not follow.
I think India said that it will not.
You will benefit because demand in the United States will be lower. But I'd like to take a kind of step back and talk about where this is headed overall. I can't speak about the targets in India. That would be not appropriate. Governments like to set targets. What really matters is what you can implement. And I think this is where the Indian experience is really instructive to the rest of the world. I guess 3 or 4 main points. The first is that in the early days of an industry developing, focusing on L1 makes sense because you generate electricity from renewables, you dump it on the grid, somebody else manages the integration problem, and the market develops. And so that I can completely understand. We're not in the early days anymore. We're now at the stage where significant penetration of renewables has happened, and we need to start developing instruments, policy instruments, that reflect the variability of the power output and get the market signals right. We are struggling with the same question in the United States, and I think essentially every market that has large amounts of renewables is still struggling with that. There is no plan, there's no playbook for how to do that. People now know what the problems are, but we don't really know what the policy solutions are. And so to the extent that the experience in India can help focus on experimentation with different policy solutions, and then India helps kind of tell the world what it's learned while the world also is learning, that would be enormously, enormously valuable. I will say one thing about the cost reductions. Many technologies through learning effects have big cost reductions, but those don't go on forever. The famous example in history is of gas turbines, 20, 30% reduction in cost for every doubling of capacity, but then that slowed down. And I think we're starting to see that in solar. We're plausibly starting to see that in wind. It doesn't mean that innovation is over, but it means that we're starting to see some plateaus. And so we have to be very careful about just extending those curves out into the future. I want to talk a little bit about scale, what we've learned in the rest of the world about scale. There's a lot of academic research out there to try and address the question of what's the maximum amount of renewable energy you can have on the grid. And of course the answer is it depends, and you'd expect academics to say it depends, in part because that's a perpetual employment program for us as academics. But it depends because it depends on the characteristics of the supplies and the grid and things like that.
What else do you have in your grid? Yeah.
Exactly. And it's been interesting because grid operators have responded. So people are now running big coal plants and even nuclear plants mid-merit in a way that they never thought they could do before. It's not very good for the plant, but this has been one of the kinds of responses. The academic work suggests that up to about 60% or 80% of renewable penetration in ideal circumstances, you could imagine integrating renewables. I don't really believe that. I think that the real numbers are smaller because in real grids where you have real reliability concerns and not everything is optimally designed, the effects of errors in forecasting and so on magnified. Let me give you an example. The Southern California grid is now 1/3 renewables roughly, dominated by solar for various reasons. In addition to the fact that California is a very sunny place, we have a lot of solar power. With 1/3 renewables, we have seen this last spring the largest curtailment of solar output on record. And so already with 1/3 of actual power output on average as renewables, we're not able to integrate fairly effectively. So that gives you kind of some sense of these kinds of issues. I want to just say a couple things to close in my opening remarks here, which one is about integration. I think grid operators around the world are now struggling with and finding lots of ways to integrate renewables. We, as techies, as engineers, people with a kind of engineering bent, tend to focus on the technical side of that. So we're very focused on batteries and on battery storage. We forget that globally there's much more storage in hydro and pumped hydro than in batteries, and so batteries are exciting to everybody, but actually most of the action is in pumped storage. And we also forget that a major way of integrating renewables is demand response. And so to the extent that it's possible to introduce tariffs that generate demand response, and we understand how demand response works, in some sense demand response and storage are substitutes for each other. They can be complements.
They're complements in some ways.
They're complements, but they're often substitutes.
Yeah.
And so your views about the viability of demand response has a very big impact on your views about the future of storage. What we do see is the duck curves are happening with a vengeance. So this is the famous curve in solar-dominated systems in the late afternoon as the sun goes down and power output from solar drops, but demand for electricity goes up. You see this big spike. That's the back of the duck. The duck curves that have been projected for Southern California for the year 2020, we now already see some days last year. And the kind of steepness of the back of the duck is beyond what anybody could have imagined. And so I think the reality is that the integration issues are going to be much harder. And the last thing I'll say is we have to remember, what is it we care about? I think when you read the press in this area, people seem to care about renewables because they like renewables. And I think it's important to care about something. But if what we care about is emissions, that's not the same thing as renewables. And I'm really worried about that, because if you integrate a lot of renewables into a grid where the marginal source of energy is a mid-merit, low-efficiency, high-emission power plant, like a coal plant, then emissions actually go up. And that, in fact, has been exactly the German experience. The German emissions are going up for a variety of reasons, including the phase-out of nuclear power, which is not complete. But Germany is one of the most successful countries in introducing renewables, and frankly has not been very successful in reducing emissions. And I think that's something we have to keep in mind as we go forward.
Thank you, David. Sobering remarks, but probably reality, I think. And this point I want to come back to is, what's the rest of your grid look like? And we also have people in the audience who may comment. Do we have time of day pricing, for example? That would really enable demand response and storage and many other technologies and solutions. So this frameworks issue includes time of day. For a procurement perspective, when people say time of day, everyone thinks consumers paying time of day. That's the other side of the coin. The first side is we need contracts for buying power for the utilities, discoms who buy, to recognize that not all power is the same. Where, when, what ramp, what predictability, they're different. So that's that problem with the L1 for saying what's a good electricity. So now it's turning over to people who deal with L1 and a lot. Gagan?
Thanks, Rahul, and thank you, David, for that.
Sorry.
I turned mine off.
I think this is better. Yeah, thanks, Rahul. Thank you, David, for that perspective. I think when I sort of look at tariffs, I step back and look at it as something sort of impacting renewable energy generation. And RE generation itself is one of the three pillars, along with storage and transmission, which is going to be changing energy as we know it, in our lifetime. But getting back to the tariffs today, there's a lot of talk about tariffs hitting rock bottom in India. But the reality is that tariffs are actually not the lowest in India as compared to other places in the world. I mean, we are at ₹2.44, which is about 3.75 cents. In the US itself, you've hit below that. Correct. Mexico is 3.5. You've had Dubai hit at 2.99. Again, cost of capital is a separate issue, but absolute tariff levels are even lower. I mean, Abu Dhabi has hit 2.4. Chile has hit 2.15, and Saudi has hit 1.98. So there's no way that I believe that we're actually the lowest in the world. Far from it. I also think there's certain sort of contractual reasons for the tariffs to be where they are today. First of all, when you look at the power purchase agreements in India, you have a structure where you are signing a power purchase agreement either with a central organization who is not the final off-taker, or you have a PPA which is signed directly with the state discom. What you have is a mirror power sale agreement where the central off-taker agrees or contracts to sell to the end user, which is the discom. Now, when you look at these PPAs and the PSAs, they are more in the nature, as I was telling Rahul the other day, of pay for what you take, rather than take or pay. So there's no sort of financial obligation or no consequence on the discom for not off-taking certain amount of power or any power. And there's various shields that they sort of hide under, and they can hide under. I'm not saying they do it, but that is a tangible risk. So the reason why tariffs have gone low, and I'll talk about returns afterwards, is to ensure that this product that you're generating moves out the door. So this product is low enough, attractive enough for the discoms for them to buy it. And that is the overarching reason. It's not a competition to secure capacity as such. It's a competition to secure capacity at a tariff where you are almost quasi-writing an insurance policy on the guarantee of your product moving out the door. Now that is one aspect. The second aspect is this product that you're selling, what do you compete with? You're competing, at least during the daytime for solar, with other sources that these discoms offtake from. And that number, or a number for that cost, is represented by the average average pooled purchase cost that these discoms pay for pooled energy. So that blended cost is somewhere in the range of 3.5 rupees. So it's no surprise that tariffs for renewables, for solar, would fall below that number, and it's no surprise that they would fall much lower than that number. Now, I'm not, I don't want to get into a debate on the merits of a particular tariff. That's not the idea here. But clearly, there's a logic for it to be below 3.5, and there's a logic for it to be really low in the first place. That's from a purely pushing the product out from the door perspective. And again, it's no surprise that the NTPC chairman himself has said 3.0 to 3.2 he sees as a tangible, realistic tariff for solar. So we're talking about 4 cents. So he says that. I mean, he's been on the record to say that. So that sort of takes care of the pushing the product out the door. The other side of the coin is returns. Now, when you look at returns, is it correct to benchmark the returns you should expect from solar against thermal? Definitely not. I mean, certainly not, because the risks, both in the execution phase as well as the O&M phase, are far different. So if you say that a 16% IRR is what you're seeking for thermal, then you have to sort of believe that your target return from solar should be much lower. I'm not going to get into how much lower, but that's one aspect of it. Now, the second aspect of it is that a lot of people tend to believe that their cost of capital is something that should drive the expectation of how much money they should make from a solar investment or from any investment. I mean, that's a misunderstanding. The target returns you should make from any investment should represent the risks and return profile of that investment. So it doesn't make much sense to me to sort of say that, well, Japan has a cost of capital of almost zero, and therefore they should invest in India in solar because that's all they're going to want to make. But that's not really the case, right? If you invest yen in solar in India, the first thing you do is transfer, or you exchange that yen into rupees. And the moment you transfer it into rupees, rupee chases rupee risk. That's a fundamental sort of thing to understand. And thirdly, I mean, when you're talking about what should be the required rate of return from solar, there's some empirical studies from the US that sort of clearly show that the required return for yieldcos, so these are operating assets, not under development assets, the required rate of return from yieldcos is significantly less than it is for traditional sources of energy generation. And the numbers that I've come across are in the range of about 6.5. So 6.5% is what dollar seeks in the US for operational yieldcos. If you want to get a good estimate of what the forex hedging cost would be, and Vikas will probably give us a better idea from a bank perspective. But I sort of look at what NTPC, it costs NTPC to raise rupees overseas and dollars overseas. So the NTPC dollar bond issued at yield at about 4.15% in London. And the Masala bond, which is basically rupee risk, at 300 basis points above that. So there's investors out there looking at the same piece of paper, same underlying credit, but different currencies, charging or looking at a 300 basis point premium. So you add 300 basis points to 6.5, you get to about 9.5. How much more do you want to add for execution risk for a solar project? Maybe 100, maybe 150. So really the target return for solar in India is nowhere close to 16%. And it's nowhere close to the cost to capital of a guy who's bringing in dollars. It's somewhere in between. And it's, if one builds it up, you're getting to a number which is not way off what the current tariffs actually represent.
So if I extrapolate that thought, we've already achieved where it can go, and now further improvements will get much tougher? Or am I reading too much into that?
Well, certainly the pace of fall, I
Will
don't think
come
is as you get closer to the bottom, it doesn't sort of decrease as quickly. Secondly, on the flip side is the concern that not enough capacity is being tendered out by the government. So if you have a lot of money chasing a limited market, that will wash against the tendency to flatten out, And there is tons of money chasing solar in India, for sure.
Thank you. Vikas?
Thanks, Director. And I think I somewhat agree with Gagan on the tariff side, but from a banker's perspective, I'd like to get out of this tariff view for a while and just to understand where exactly is the capacities and the utilization of these capacities heading. And from Yes Bank side, we've been engaging with a lot of stakeholders, and we've been really lucky to engage with Rahul on and off in a very interesting discussions that we already obviously have on these topics. One area where long-term investors like debt, the bankers have a real concern is about how the utilization of these capacities will happen and how discoms are building themselves up in terms of their financial health, in terms of their operational efficiencies to take up these additional renewable energy capacities. Discoms have been given a lot of thought in the last 3 years, where government have introduced a lot of programs, basis which this capacity addition that we've seen in the last 3 years, which has happened almost more than double the capacity which has already been installed from the 2013-14 levels. And in this capacity addition, we've seen multiple discussions, multiple issues already, being discussed at various forums about how are these discoms going to, tackle the challenges which they are offering. Already in 2017, we have seen a major shift in the thinking of, discoms, states, about the last 3 years growth and the growth that we are now foreseeing in the next 3 to 4 years. The 3 to 4 years growth in before 2017 is now in question, because people are questioning, what were those tariffs about, when we are actually seeing a significant drop in just 2-3 months of bidding to these levels. What will happen to those contracts which were signed, which were financed by lenders, and which are now facing questions about their tariff being a bit higher from the 2017 tariffs. So this is one big challenge where we need to convene ourselves up with other stakeholders and really find out what is the major impact of all those development that has already happened. For the future 3 to 4 years, at least till the time we have given ourselves a target for, how this increased generation from renewable energy will be utilized in the grid. One area where we are also advocating with the government, with the other stakeholders is how to get discoms online to take this additional renewable energy. One bigger suggestions from our side is getting discoms out of the trouble of the whole politics about electricity in India, and how discoms can be made a market player rather than a political player, in the hands of governments and states and central ministries. One thing by which this is largely possible is the way government has done in gas, and they are now thinking about fertilizer, is the direct benefit transfer. How they are doing that eligible consumers to be linked through digital payments mechanism, and the intermediaries like the gas distributors or discoms in power sector, can they be avoided to fall into that value chain of managing those subsidies or those political ambitions which people would normally like to have in this basic value chain. So a direct benefit transfer is one thing which we as a long-term stakeholder in this sector are actually advocating, by which discoms may be actually spared of all this managing subsidies, and in a way to improve themselves in terms of their financial health, and be ready for this huge influx of power, huge challenge of tackling growth in electricity, which Rahul just mentioned. While the estimations are there that the growth in electricity is paramount in India, and it is going to happen, but how will that be actually serviced? How are the Indian players like discoms and private entities really ready to actually service that huge growth in electricity that we are estimating? The other thing is, this is the one part where discoms are in the picture, and this is actually 90% of the picture, where the additional generation capacity would obviously be dependent upon. The other 10% part I want to talk about is about the way the markets are changing now. The markets are trying to bypass discoms and find their own consumers, the generators, the developers, the independent distributed generators like rooftop players or rooftop owners, how they are going to bypass discoms and find their own market. The one big market is visible, is electricity vehicle, EVs that we call them, and how we can club our renewable energy targets with our EV targets and make a suitable infrastructure possible with justifying business models, with good amount of participation from private and public both entities, and club these targets of both the areas, both the sectors, and work towards it, rather than just focusing on challenges which needs to be tackled at the discoms level or the state governments level. How can this be integrated, and we can just move quickly towards that. The other big area in that 10% category is the open access customers. The open access customers, of course, they are high level, high value paying customers to discoms, but if their demands are growing and discoms are not able to service them, there needs to be a space for them to actually source their power themselves. And in renewable energy developers, at least, we are seeing a lot of players, a lot of bigger players entering into this domain and finding their own customers wherever possible. The only challenge lies is how do we standardize their contracts in the open access category. Different open access customers are demanding different types of clauses, contracts, and this would actually not help in taking this particular sector off with the growth targets that we want to have. So this is one area where, as bankers, we would love to engage in standardizing the way people want to operate, and make them more bankable, make them more economic, make them more justifying in terms of their economic sense. Thank you. Thanks.
Hello, is it? Yeah. A few things that Vikas mentioned right now. Earlier on, he mentioned the irony that it's the high tariff PPAs that seem to be coming up, seem to be risky. So that sort of reaffirms my point that it's the value of a piece of paper that says the buyer is going to pay X rupees per unit is only worth its weight or more if the buyer is willing to buy it. And in a world where there's no obligation, or there are carve-outs, there are ways to escape that liability or that the commitment, there will be a race to the bottom. And that race to the bottom has negative connotations, but one needs to sort of weigh it against what should be the actual rate of return one should expect. Now, it was great if one can expect a higher rate, and you're operating in a market where a higher rate of return on your rupee is possible. But in an open market with lots of players, very little barrier to entry, you will get to that normalized level. Second thing that Vikas mentioned is the non-utility scale bit of the business. I mean, solar, you can either build to sell to the discom, or you can build to sort of use it for yourself. When you look at rooftop today in India, it is about 1 gig out of 12 or 13 gig of total solar. So that's less than 10%. The world average is something like 40% today. Australia, 90% of their solar is rooftop. And that's really because of a unique condition where Australian retail energy prices are about double, triple what they are in the UK and US. But as I was telling Rahul earlier, that if you want to look at where we are today and where we need to be by 2022 to achieve our targets, and I'm not fussed if we don't or not, as long as we get close, but if one needs to sort of get close to that, wind has to grow by 2x, utility scale solar has to grow by 5x, but rooftop has to grow by 40x. So, when we talk about achieving the targets, rooftop to a certain extent is the key. Can't achieve them unless rooftop picks up.
Yeah, can I just briefly comment on this? I wouldn't necessarily look to the rest of the world as revealing what the optimal balance is between central station and rooftop, because first of all, you've got these oddities in the tariff structure, which persist so long as there's not too much erosion of the customer base. And now in places where we're seeing that erosion, we're seeing the utilities fight back. And also we have to remember that the politics of renewables are very, very attractive. And so there are a lot of places that have tariffs and support for renewables where when you take a step back, it doesn't actually make a lot of sense in terms of what's the most cost-effective strategy, but politically it's very popular. And local generation is even more popular. And so I think when you think about this from an engineering point of view, I can't speak about the Indian situation in particular, when you look at this from an engineering point of view, it's actually still central station renewables that make the most sense at scale. And so I just would urge that we not overreact to the fact that the rest of the world in some sense has maybe over-deployed rooftop and use that as a benchmark for India to try and do the same thing.
I mean,
so I think my point was that it's, we're certainly at the bottom of where our peers are. And I'm not advocating a 90% or 40%, but I think there's certainly some room.
we're behind.
Yeah, we're behind.
We're behind, yeah.
Rooftop.
So I think the point about distortions and tariffs driving it is key, because in India, you've got the C&I, the commercial and industrial, the so-called paying customers, will be the first ones that go to rooftop as it scales, or big-scale residential, which drives me crazy because you have, in some states, 30% capital subsidy for residential rooftop, so you're subsidizing the rich, is what you're doing, which doesn't make sense.
We should watch C&I customers on many fronts, not only because they have the scale of demand and professional operations to be able to do their own self-generation, but what we've seen in the California market is they are also the early adopters of on-site battery systems. Now that's because of the tariff structure around what are called demand charges,
yeah.
capacity charges. But when you think about the fundamental economics of the power grid, they point you in the direction of demand charges or capacity charges. So that's actually a kind of revealing fundamental behavior. And it's the C&I customers that have been the earliest adopters of these on-site battery systems. So it doesn't allow them to become independent of the grid, but it does create a huge risk to the traditional utility that's making a lot of money, usually pass through, but a lot of money around charging demand charges that then are now in play because of these battery systems. It's in my view, it's actually a more interesting development now than the spread of renewable power, because it's been so quick and so fundamental.
So I think that alludes to the next sort of general point. You talked about renewables and a lot of other transitions in this space coming at the edges. You want to bypass the discom is one sort of phrase. You want to sell not necessarily to one, but directly hook your RE to the central transmission unit, the CTU. Well, that only scales up to a point. So one of the fundamental questions that starts academic but then becomes very real very quickly is, at what point does that break? Because you're not just chipping away at the edges. Your fundamental core could get hollow at some point if your paying customers go to one way. I mean, at the Rooftop example, the extreme end is called Uberization, for lack of better term. Uber is not the most popular company to use for that example, but it's disruption from the edge, and in some cases enabled by digital. And we can fight it, but it's already there. So you mentioned that open access, some 10%, that number was in play. But if you step back and look at the numbers, in Maharashtra, according to one Prayas study, even a couple of years ago, 50% plus of the units sold were actually sold higher than solar. And so if you look at HT consumers, the high tension, the big consumers, they're a small number of players, and yet they're 40 to 60% in many states of units that are eligible to exit the traditional system. In fact, de facto can. It's other issues, like you said, carve-outs. There's all these other mechanisms that are resistance. Is it just that we're fighting a battle where the dams are leaking and we're just putting our fingers in, or is it going to be a slow and controlled transition, or at some point do you think things will snap?
I think if I can just sort of point to a few things that have sort of driven the renewable energy boom, or whatever word you want to use. There's been, we already talked about the tariff. Now, you know, for every developer or seller, there's a buyer at the end of it. So if tariffs hadn't fallen, there would be no buyers for it. So let's just, that is, if we park that aside, there's also been certain measures that the government has taken: solar parks, central offtake, infrastructure investment trusts, which actually have an impact beyond just solar. So these are clear measures that have sort of benefited solar and renewables. Going forward, in terms of what I see the bottlenecks are, in terms of what might hold back renewables, the funding definitely is a bottleneck. I mean, today we have about 6 lakh crores, which is about $90 billion of exposure by the Indian banking system to power. In order to get to the targets, and again, as I mentioned, I'm not really onto the targets.
Is that RE or total power?
Total power. $90 billion with a B,
Yeah.
exposure to the power sector by domestic Indian banks. So if you are talking about increasing from 50 to 175, you're looking at a number which is almost equal to that, a bit short. There's just not enough headroom in the Indian banking system to absorb that much additional exposure, both from an absolute perspective as well as concentration risk. So clearly the money to get to 175 or whatever that number is going to be has to come from overseas. Right? There's no way out of it. And the way that capital is going to come is, in my view, the primary development risk is always going to be financed by Indian banks, because the bond market does not like development risk or execution risk. And typically the model that I see evolving is Indian banks finance primary execution risk, development risk, and the bond market, whether it's a local bond market solution or overseas bond market, does the takeout. And that money is then recycled in the Indian banking system, and this carries on and on and on. So that clearly is the way forward. And I think the InvIT structure, which allows companies to upstream cash without paying a dividend distribution tax, is a great way to sort of work around it.
Can you comment just for a moment on whether you think the international bond market will be able to absorb the currency risk?
The quantum of currency risk, that's an interesting point. But in terms of how bond markets... Yeah, well, you know, $90 billion of rupee risk, if that's what you're talking about, is, yeah. So it's not, it's not going to be just the overseas bond market. The Indian bond market also has to take its share, as well as what I would call private debt funds. So the bond market was a loose term for pools of money that are not channeled through the banking system, but direct to the investor. But having said that, I think the offset here is compared to other infrastructure. I honestly believe that renewables, if done right, offers a far lower risk perspective, than other infra.
Can I make 2 comments on this?
Sure.
First, what a sign that the revolution has happened, that we expect conventional power projects to require a higher return than renewable projects. That this is a sign that really the world has changed, and so in that some sense that's pretty extraordinary, because I think most people not so long ago would have modeled this the opposite way. So that's pretty incredible. To me, I think this question of how much rupee risk can be absorbed as it scales up is a very important question, and people should be doing some work on it, and maybe some of that should be done in an open setting where we could help at Brookings India. To me, the issue for these renewable projects that's really important over the long term is the credibility of whatever the counterparty arrangement is. So you asked, will the system break? Or somebody asked, will the system break? I can imagine discos breaking and so on, but the role of the wires remains fundamental. And so presumably if there aren't big errors made along the way, some mechanism will continue to be there and assembled to keep the wires in place and to value that, because the value of the grid is incredibly high, even for all these distributed systems and so on. The value of the grid interconnection is, for a whole range of reasons that people understand. The value of the grid is where the real pivotal value is. If there's one thing I would watch very closely, is what happens as more renewables are not dispatched. So the question of who pays for that, which we've seen in lots of different markets, that not really contemplated very well in the classic PPA. But as the share goes up, especially if you have grid congestion and so on, you're going to have renewables output that's not being paid for. And so if there isn't a way to either socialize that risk or somehow credibly cover that risk, then you could see the expectations around risk, not so much execution risk as operational risk in these projects, go up a lot. And that could be hundreds of basis points.
I mean, in California, there is a mechanism, and we've been talking to them to try and understand how to adapt it for India, where they have to spell out curtailment, whether it's technical or economic, and break it down by operator side, local, or grid scale. Where was the congestion and what? Because as of now, we don't have the data on what's even happening at the lower levels of the Indian grid. Forget the curtailment level. And there's a lot of disputes. Now, is it just a commercial dispute between both ends, or are there policy frameworks to manage that?
But it would be important to look. You should look at multiple markets. Hawaii is another example. The European markets. It seems to me that when we as analysts start looking at this, we have a tendency to focus on the knobs and how can we turn this knob and how we turn that knob and so on. And I'm glad somebody's paying attention to the knobs. But what really matters is the credibility, ultimately, of whoever's guaranteeing the payment structure. And so I would focus more on the credibility and less on the knobs.
Exactly, and I think this is where I wanted to bring this point about discoms, how they're going to tackle their challenges, and while central government can do as much by bringing in schemes like Uday, which has been there for the past 2 years, more than 2 years now, there seems to be not big clarity on how operational efficiencies have been built in to take care of the future, or avoiding the future losses, as we can say. So that breakage point, Rahul, as you mentioned, is going to be how the discoms, the transition of this business shift from discoms to the open access, or you say the bypassing of discom happens. And if it is slow, if it is thoughtful, I think there will not be any breakage point, because there will be business models around it where discoms can manage themselves up, and as well as cater to this big stream of consumers who want good quality of electricity available through open access, either through discoms or through open access, and still manage to serve a bigger chunk of retail consumers which are there in the state. Of course, as you mentioned, the rest of the 50% in Maharashtra can they service them, at a profitable level, and just think about how they can improve on their efficiencies in managing them.
One of the mechanisms that's been used to handle open access, forget before the renewables, has just been to talk of cross-subsidy surcharges, wheeling charges, and all of these. On the other hand, current policies talk of waivers of all of that for renewables. So the question is, how long can that work? I want to come back to this more broader transition. You mentioned surprising changes, whether it's through maturity or just this time is different with renewables worldwide, like the risk levels can actually be lower. But traditionally, people have said that let's have energy markets for electricity once you're mature. So capacity versus energy markets is one sort of a design debate, and there's pros and cons. But if we just think of energy markets for a second, two things sort of strike you. One is renewables have a zero marginal cost. So if that's your signaling, then you're going to be driving prices down very often, very much. And second, how do you actually incentivize the growth, which is what India still actually needs? So if we use a framework that says renewables can price cheaper than coal, the numbers you quoted were compared to the average power procurement cost. But if I look at the marginal power procurement cost, and now your question of what's your next incremental, David, which is coal in India's mid-merit. I mean, coal is your mid-merit in India because we don't have gas sufficient. The US uses gas for merit, load following. Variable cost of coal is not 3.5 rupees. On all India basis, it's closer to 2 rupees, plus or minus, varies by location, because railways is your big differentiator. So compared to pithead, where you may be 1.2 rupees variable cost, renewables seem to be a world away. So if I'm a discom,
Yep.
and I have to have this coal plant because there's no battery, at least in the near term. So I have to have the coal plant because other than the bell curve of solar's output, I know I need something else.
Sure.
Now I have to pay them. In the middle of the day, my PLF just falls, and not just PLF, but my efficiency of my plant can even fall because of the increased RE. Then my decision making, do I want more RE, looks very different if I'm trying to decide who to dispatch versus who to set a contract up with to buy another power plant. That's a problem that I don't think has been solved. I mean, US is in a very different place because it's got sufficient capacity, relatively speaking, while India's in a growth rate to some extent.
For a lot of moving parts there, Rahul, so we talk about some parts of it. First of all, just the United States is a diverse country, and so in the Southwest and the Northeast, it's gas at the margin. In the upper Midwest, there are many nuclear plants at the margin. In the Southeast, it's coal at the margin, which is one of the reasons why there's really interesting research showing that electric vehicles in the Southeast, under some conditions, actually raise emissions, not lower emissions, because you're powering them at the margin with coal. And so this just, what's really at the margin has an impact, and it's just a reminder that if our goal is emissions, not just greenhouse gas emissions, but emissions of all kinds of pollutants and so on, if our goal is emissions, the more work we do in this area, the more important it is for us to focus on policy instruments that actually target the emissions. I think the lesson in most of the world around the use of markets for power has been exactly what you alluded to, which is we need separate markets for power and for capacity. It's possible to run a pure power market, and if you have a lot of backbone to allow the pure power market to get the right signals. This is done in Texas, for example. But there's a lot of cowboys in Texas, and a lot of things happen in Texas that can't happen in the rest of the world, where they have a pure power market, and every once in a while power prices rise up into the stratosphere, and more than every once in a while they go negative. And so there are now people trading in the pure power market and generating outcomes that are actually pretty reliable with lots of wind and lots of coal and now merchant storage. That's very hard to make work in most of the world. So I think for most of the world, I can't speak about the Indian situation, the lesson has been we need to think about capacity and ancillary services as separate, distinct markets from the kind of pure, short-term bulk power. You were about to say something.
Yeah, I think 2 points you made, David, on emissions and, let's say, diverse market. If you look at the split, or the pie chart of the emissions in India, the source of emissions, about 38% of it comes from electricity. 7% of it comes from vehicles. So almost half of what you see outside is coming from electricity and vehicles. Now, imagine a world where you had 100% renewables, when storage came around, et cetera, became cheap. And by the way, I'm a big believer that storage costs are going to surprise us in terms of how fast they come down. Because storage always needed, and this is the other point you were making, always needed renewable capacity to make sense in a certain way. Otherwise, you were just shifting emissions from the tailpipe to the chimney, right? It just, on a macro level, it just didn't make sense. So storage follows, I think, renewable energy. The more renewable energy capacity that you have on the ground generating, the more storage will be attractive. And that's just going to create a virtuous cycle of storage costs coming down faster than we expect. So that's, clearly from an emissions point of view, from a storage point of view, there's a lot of merit in looking at renewable energy. The second point you were making was the diversity of the US market. And, Vikas also talked about the discoms. I mean, in India, we have 25 odd states, give or take. And we have
29, I think.
29, something like that. I stopped counting, And we have more than 40 discoms. And that's a lot of discoms for any investor to sort of get their head around, let alone a foreign investor. The second point is the credit worthiness of these state discoms is also kind of a bridge too far, I'd call it, because the central government does come out with something called an integrated rating booklet for state discoms. But if you read the fine print, and those numbers look very fancy, A+, B+, CC, triple C, whatever have you. They look very appealing and seductive. But it's not credit risk, because credit risk is the assessment of probability of repaying your financial obligations via an assessment of probability of default. That is what credit risk is. These alphabets that have been assigned are actually called gradings. And these are gradings of the financial and operational health of these discoms. So whilst it's gone a long way in helping us understand what lies beneath these discoms, it's not yet good enough for an investor who's sitting overseas to say, well, $100 million for XYZ discom, or PPA, which has XYZ discom underlying it. So, that diversity is a bit of a hindrance here in India, where I don't really see a deep market for pure discom PPAs from overseas. So clearly the bond market we were talking about earlier, those dollars are going to primarily flow into PPAs which at least have an NTPC, or actually NVVN, or a SECI in between, to give that added layer of comfort,
Mind you, this grading you mentioned is actually based on a 2 to 3 years old financial results.
So there you go. Yeah.
Yeah. So, I mean, one of the, if I want to put words in your mouth or take it too far maybe, is on average the system can't handle that because you've got 78 or whatever number of discoms and players. But is it that obviously NTPC is investment grade and certain other players are investment grade, so it's on the back of their balance sheets that really we're seeing this action? But then at what point does that run out till you start actually hitting the next layer is sort of one of the big questions to meeting these targets.
I think, as I talked about earlier, when you talk about a PPA and the kind of revenue stream that underlines that PPA, it's got two elements. One is, does the PPA ensure that my product goes out the door? The second element is, once that product goes out the door, will I get paid? The PPAs today do not ensure the first part. Yes, there are sort of consequences for not continuously uptaking the power, but that consequence is an event of default. I mean, what good is an event of default for me as a developer? Doesn't really help me. So it's the price or the tariff that works to the benefit of ensuring that product goes out the door. But the security or surety of my payment is actually governed by a tripartite agreement between the central government and various state governments, which dictates, and I haven't seen that tripartite agreement, I'll be honest, I don't think too many people have, but the belief is that it works very well in penalizing states who refuse to pay for power that they have sort of off-taken. In that central grants of an equal amount, I think, are withheld. So that system of guaranteeing that payments for power once taken comes in the door is an important leg in sort of why certain investors view the NTPC and SECI PPAs to be more valuable than the discom PPAs. And I don't think it's I've thought about this, I don't think it's an additional risk that's put onto NTPC balance sheet, because at the end of the day, it's not NTPC that's forking out the money. It's the central government which is withholding the grants. So there's no really incentive for a state government to not pay for power when it knows that if it doesn't pay for $100, $100 is going to be withheld. You know, there's no this
remains to be seen. I mean, politically with elections and all this. So I want to change a little of the format because we have a lot of hands I've seen, a lot of comments and questions. But we also have some people I would like to reach out to say a few words. And then we'll come back to the panel for both final thoughts as well as the point about suggestions. What's missing? It's very easy to say what's wrong, but now let's look at what's right or what we can do. So we'll want to close with that. So we'll first come to the audience, and I would like to welcome and ask Mr. Pankaj Batra is here, member planning from Central Electricity Authority, who actually deals with many of these spaces. I talked about frameworks. Can we get some mics for the audience? We'll use one of these. Yeah, yeah. You know, you've been a passionate expounder of time of day tariffs. For example, CA and yourself, you've spent time, even from your CERC avatar, looking at more nimble frameworks. That's been one of the needs academically talked about. But where are we on operationalizing this? It's something that many of us recognize, but why hasn't it happened, or what's next, or how is this possibly rolling out? Mike is here. Yeah.
Yes, time of day has been there in the policy since quite some time. It was not implemented, both at the consumer level as well as bulk purchase of power. And we did move a note a number of times, and it's now gone to the Forum of Regulators. And there's a committee of Forum of Regulators under member technical who's getting it, who's in the process of getting it implemented. I think it should happen now, maybe 6 months or so. Let's hope it does. That is the status of time of day. But I'd like to, of course, it's going to help us in planning, because if time of day flattens the peak, and you don't need so much peaking power. And when we plan for future, we'll have to estimate what is the right amount of peaking power you need. I just wanted to correct some notions which were discussed here. One was that the reason for falling tariffs, of course, you mentioned that it could be because it was not getting into the merit order dispatch, and therefore they wanted to bring it below that. But a more important reason is that two reasons. One was cheaper finance is renewables, because they got access to cheaper finance. And second was the penalty for non-offtake of I think less than 85 or 90%, which was not there in previous contracts. Although it did say that they were must-run units, but it was not being actually done. And here there's a penalty in these the new competitive bidding document which was prepared for solar, for Bhadra and the others. One of the reasons was that because there's a guaranteed offtake of I think 85 or 90% of the power, and that there's an amount which is mentioned in the PPA which says that if you don't, then this is the amount you have to pay. So that is one of the things which has reduced the risk of taking offtake of power. The second thing is that you did talk about the tripartite agreement. The tripartite agreement is basically for central generating companies, not for private companies. And that also, if they have a clause in the PPA mentioning the tripartite agreement, and that is that if the state distribution company does not pay money to the central or state generator, mainly the central generators basically, then the government can deduct that money from the money that it used to give through plan allocation to the states and give it directly to the central generator. But that plan allocation for the states has actually finished since the Planning Commission got abolished. So I really don't know how it's being done right now. But that was that. It is not for private generators. So there was no saving grace for private generators in this. As far as balancing of renewable generation is concerned, we've done a lot of study on that, and there is a cost for balancing, or for all the financial implications for off-taking renewable because of the low capacity utilization factor as well as the intermittent nature of the generation. And we have, using certain assumptions, actually certain actual calculations for Tamil Nadu and Gujarat, where with the penetration of 30% renewables that we did recently, we got a figure of around 1 rupee 20 or 30 paisa per unit of renewable, and that considers the inefficient operation of thermal plants, which is coal-based as well as gas-based, the lower plant load factor, so the fixed charges are not covered or they are compromised to that extent. The additional transmission cost because you're not fully utilizing the transmission system. The UI charges, which is the deviation settlement charges, which is violating the limits of deviations for interstate flows for these renewable rich states, as well as standby capacity required for meeting this demand in case renewables go down. So it covers almost everything. This costs, there was a lot of discussion about very high costs to these renewables. So we'll put that report on the website, which gives the calculations, the details of calculations, so people could see it also themselves. But I'm saying it's not such a high cost because there were people who were mentioning it as high as 5 rupee per unit, which is not actually, didn't work out according to the things that we did. And this also includes backing down of cheaper coal-based generation in order to necessarily offtake must-run renewables, which in future is not going to be a concern because in future, for all future contracts, the renewable generation is coming down to the same level as a coal-based generation, the variable charge almost. Because you have the fuel charge of coal-based generating station ranging from 150 or 130 or something, right up to 3 rupees, depending on the distance from the coal mine. So in average, it comes to around maybe 2 to 250. So there's not going to be too much difference there. But right now there is, because the old PPA contracts for wind and solar are at 4 or 450 or more than that. And you are necessarily taking that generation at the cost of backing down sometimes coal, the marginal cost of generation we took an average of 2 rupees or so. So that is not going to be a concern of future because these are old PPAs where the costs were higher. The new PPAs are much lower, so it's come down to 250. The price difference between marginal and the price of fuel charge is keeping on going up because that cost doesn't reduce. It includes the cost of salaries of people. The salaries never go down; they always go up. So we don't expect that to be a concern in future when you want to compare renewable prices versus the marginal price of coal.
Thank you. So this is very heartening that not only has the exercise been done, but the number is somewhat lower than what some people were thinking.
Yes.
So the only counter question is, these are accounting for these so-called hidden costs of opportunistic RE, which means today's RE, take it when you can. But if I'm now looking at the scale that we're talking, when you talk of the larger numbers, not just 22, but 2030 and so forth, at that point, you can't even absorb all of it because your peak demand today is barely touched 160 gigawatts. And so curtailment risks become enormous, or you need a battery. So even though this manages us in this transition, it's not clear that you've solved that larger problem with this framework that we have.
Right. So this is actually depends on country to country, depending on what resources they already have, what mix of resources they have. In India, we have fortunately demand which is still growing at the rate of at least 6% per year. So we can afford to absorb, or we can afford to plan for the future. Whereas most of the other countries, the demand is almost flat or sometimes negative. So they are stuck with the set assets that they have. Fortunately, we don't have that problem. So we can plan efficiently. And for planning efficiently, we've done a study of using battery, where we have used for a 100 megawatt wind plant, a battery of 10 megawatt for 4 hours and 20 megawatt for 4 hours. In the first case, 10 megawatt for 4 hours, we've been able to flatten the wind generation to quite some extent, not exactly a straight line, but to quite some extent. And for a 20 megawatt for 4 hours, we've actually converted a wind generating station into a peaking station. So we have that. So I'm saying that depends on future prices of batteries. Yes, we would not like our assets to be underutilized. So demand response, as you correctly said, is a very important thing, and which is already being used in many countries, including US. Demand response, some states are already aware of it. So Telangana has necessarily said that agriculture supply, which is to be given for 7 hours, will be given only during the solar period, during the daytime when there is high solar. So they don't have to back down thermal to that extent. And we have said the same thing to many states, that they were earlier giving this agriculture supply in the night after the peak hours, where they had the farmers also complained of snake bites and by other bites, insect bites. So this will also help from that point of view. And we've also proposed, or we've suggested that there should be a thing called automated demand response, where if you don't know how, solar is more predictable, but wind is not so predictable. So if the wind goes up and down, you have two types of tariff. One is reliable tariff, which is 24/7, for which people should pay extra. And the other is interruptible supply tariff, where people can be, it can
We
be
have that
interrupted.
today. We have that today.
No, that is, but the tariff is not special there. We say that people who don't mind getting interrupted and paying a lower tariff, or they can even have two connections, or in the same meter, 2 points, one which would give reliable supply tariff and the other which would give interruptible supply. And you could connect whatever you want to whichever side, depending on how much you want to bear. For example, if I was given the option, I would connect my geyser, which is a heavy, which draws heavy power, 3 kilowatt, as well as an automatic washing machine to the interruptible supply, because whenever it comes on, I don't mind, it will keep the water hot. And the other washing machine, whenever it comes on, it will resume the operation. So these sort of things are implementable, and since we are growing, we would prefer to have a framework, overall comprehensive framework, which would help integrate renewables. Now, I'm not doing anything about I'm saying that I agree that there's a problem if you do not put renewables because of health reasons and the environmental problems, but we also want to see how to do it best, in the best way. So we don't want to increase emissions. We want to run coal plants at a steady rate, PLF. And so we have the other options, which is demand response and many other things which can be done to do that.
So I mean, in the West, they've used gas a lot, and that's something that's also on the table. Thank
Right,
you.
So just one more thing. Gas is being used very inefficiently in India presently. So the government is thinking of using this gas in a more flexible manner, and GAIL and everybody have agreed to that. Now it's a question of now getting down to actual implementation, rather than coal-based stations being used for flexibilization. It would be better use the existing gas stations. We have limited gas, of course, but then we would be able to even use the existing gas more efficiently as peaking plants or as balancing plants. So we're looking into the economics of that and seeing how
the systems
to do
level.
that.
Yeah. Thank you. So we'll open it up to questions, leaving a few minutes at the end for sort of suggestions and ideas. If you could briefly introduce yourself, and please keep it very brief.
I'm Anil Seth. I'm a scientist. I got some problems. First is, who do you expect to bear the cost of safe disposal of incredible amounts of batteries and other hardware, especially in developing countries? Number two, subsidies are not guaranteed. They can be withdrawn overnight. Thirdly, what about the decrease in efficiency, especially in solar plants, and depreciation? Thank you.
Thank you. Some of these are technical questions. We'll take 2 or 3, but we'll take, yeah.
Sir, my name is Colonel Bansal. I got question regarding the supply of electricity at Andaman Nicobar Islands. Now, these islands are 1,200 kilometers away from the mainland, sir, and there are 572 islands, and there is habitation at on 70 islands. So, at presently, they are supplying electricity by producing with generators.
Diesel, yeah.
So, is there any better way of?
So, just to very quickly share, you may have seen the government has come up with a tender for solar plus battery for Andaman and Nicobar.
Yes, sir.
So they're actually trying to shift away from diesel, because diesel in Andaman and Nicobar is not just what we think of as diesel, but it's to the islands, double shipment, so it's very expensive. So I think that's a niche. It's a very important one, but in the bigger framework of the all India picture, all of the lessons, except it provides a very nice lab to test batteries and solar in conjunction. So I think all eyes are on Andaman and Nicobar to see how they exactly do what you were alluding to. We'll take one more question. Very quick. Daljit and Navroz, if you could hold on just 1 minute. Yeah, Daljit, yeah. And then we'll come back, yeah. It's not on, yeah.
I'm Daljit Singh. I work for the Center for Energy, Environment and Resources. David, I want to follow up on something that Rahul brought up about electricity markets. In India, we're beginning to think of, at least there's talk of introducing retail access. It's called separation of carriage and content. And how is that? I mean, if you don't have retail access and you compare it with the case where you do have retail access, which one is more compatible with the development of RE? I mean, what are the implications for RE when you have retail access? And if you could talk about the experience in the US and maybe in Europe also on that. Thank you.
Yes, people are welcome to jump in as they wish. I'll just mention on the technical points you raised, disposal of waste or degradation of solar. These are technical questions for which historically people have either relied on the market to find good equilibrium. If you sell crap by claiming it's cheaper, and then at some point it'll come back to you, but the only question is we're early in that, so we don't know, or you regulate it. You have testing standards, you have enforcement standards, and the folks like him, the banks, I think, are the ones most interested in trying to ensure that, hey, do I get paid 5 years, 10 years hence? Because if it degrades, that's obviously an issue. So maybe you could share how banks have thought of that. And David,
I mean, of course, these are long future thoughts about how these plants would be managed after they are out of their sort of useful service life. The stakeholders like us who are long-term invested in these plants, we have given good thoughts around how to make sure that covenants are there, the policy is there at the developer level to take care about the disposal that would usually happen. And it is actually not usually at the end of the period. It may also happen during the operation of the plant also, when there are number of modules which are not performing and they need to be disposed of or replaced, right? And there needs to be correct amount of thought about it.
So I mean, do you actually look at their business model and say, do I see a line item called disposal?
Yes. So there is a thing called environment and social impact assessment study that is done for each and every plant that we finance, and that's a global norm also, that how they are going to tackle with the disposal waste, that they need to spell it out while developing the plant. So there are, of course, independent service providers to do that for these developers, and as we go along in the development of renewable energy in India, we'll see more and more private and public players also entering into this area where they can be recycled, they can be disposed of.
So it's also an employment link.
So,
you see the plant life, the earliest start for solar and RE was Germany. And we've seen that there is legislation that they've brought about how to deal with this. So I think we can take certain cause from there. So those things are all part of our, we are behind them in terms of the useful life and those policies.
This isn't a new problem. We're not
So this
unique
isn't
in
a new
this.
problem,
Yeah,
but
yeah.
it's been dealt with in Germany and also in UK. To a large extent, they have come out with legislation on how to handle the after useful life and how to handle this.
Yeah, so let me just say that lithium is valuable, so there are incentives to recycle. And one of the things that's quite interesting, we saw this in lead acid battery industry, but we're going to see this in lithium. We're already seeing this lithium, is some integration between the use of these cells in the EVs and then their stationary use for battery systems, because they'll be extensively monitored. You have to monitor each cell for safety reasons. And so you'll also know which cells are performing at what levels, and so therefore have the capacity to extend their lifetime. So you can imagine cells starting in EVs and then going into a kind of stationary storage for a while, and then differentially being removed from that and then go off to recycling. So there might be a need for mandates, and there might be a need for more social responsibility, but let's not forget the role of the market in creating an incentive. I think this question about retail choice is a very important one. The assumption has been that retail choice is good for RE, because when people have the option of choosing their power source, they're going to, not very many people, I can imagine some, one of them might live in the White House, who might selectively choose coal, but most people are going to choose RE.
Not the cheapest?
Well, so this is precisely my point. I'm actually very skeptical that this is true, or that this is a big signal. It's true to some degree. I'm skeptical that it's a big signal for a few reasons. First of all, when retail choice has been offered, usually very few people switch. And so very few people are motivated enough to go off and choose green power rather than leaving the utility normally to purchase lowest cost power, because the utility has a social cost obligation there. A public interest obligation. The other thing is that retail choice tends to be correlated with jurisdictions that are already pushing a lot of renewable energy. And so we're doing a lot of retail choice in California right now, actually in the form of what's called community choice aggregation. But the community choice aggregators are trying to go to all renewables at the same time the state as a whole is trying to advance renewables. And so the marginal effect of all that is actually relatively small. So when I take a step back and I look at the role of retail choice globally in pushing RE, compared with direct subsidy, compared with tax incentives, compared with mandates, the role of retail choice has been a distant one, and I would say probably only explains a few percent of the variation, if that.
And I guess in India, especially the corporate and the CNI, once you're above 1 megawatt, you've always been much freer to have that choice already.
Yeah, I mean, we should say that there are some retailers that are going to choose renewables because if you're Apple or you're Google and you have unlimited amounts of cash, then you might as well spend it on some things to keep people from getting angry at you. But it's really important that we scrutinize whether these are real marginal changes in the grid versus shuffling the contracts around. Because what typically happens, this is not true for all those companies, because some of those companies have invested in real new long-term projects. But quite often what happens is that you simply go out to the renewable market and you buy credits, which are going to be generated anyway. And so the marginal effect of that is actually smaller than people expect.
Navroz, and then Professor Sengupta, and then
thanks. Navroz Dubash from the Center for Policy Research. Great panel, thank you, and thank you for organizing it, Rahul. I think most of the panel quite appropriately focused on some of the questions sort of looking forward, the financing issues, the integration issues, and so on and so forth. I was glad that our colleague from Yes Bank brought up, in a sense, the problems of the last century that are kind of an overhang in dealing with the problems of the next, which is the dismal state of the discoms. And I think that we should not underemphasize that part of the challenge. So I'm glad you brought that up, sir. I would perhaps gently suggest that the thought process, if we think that the political issues with the discoms are going to be solved by a technical quick fix like DBT, I personally am a little bit unclear if that's the case. We've been doing a study looking at the political economy in 15 states, doing interviews and so on and so forth. And my sense is that any such technical fix like a DBT has to be embedded in a larger political solution. The issue of providing electricity to people for whom the paying power is still very low, and trying to impose a market structure on top of all kinds of sort of incomplete price signals and using technological fixes like DBT to patch the holes, to my mind, is a transition that is going to be too complicated to pull off. So I think there'll be some difficult political choices to be made that are inevitable, and we should pay some attention to those and the implications of those for renewables. We can talk more about it in the break in terms of the details, but that's sort of the larger point I would like to put before the panel.
Thank you. We have
Just a quick point on that, and I think we're seeing those difficult political decisions being made in the last 2-3 years. So I think this can be a best time to actually maybe bring out this discussion forward, how we can actually tackle. So the underlying is to basically spare discoms of all these troubles. It's not about, of course, there will be technical challenges to take care. The political challenges will, of course, be the overhang. But the underlying principle is how to take care of our electricity market and make it ready for this next 10 to 15 years, rather than just people again and again discussing about challenges which we have seen in the last 4 years, 5 years. So that's.
I mean, just to piggyback on that, this is where distinction between grid scale and rooftop really matters. So rooftop, if discoms resist it because your paying customers are exiting you, that's a very different dynamic to handle. That needs different mechanisms.
But it makes the problem worse.
Yeah.
Because then you have a whole bunch of still grid-connected rooftop systems, and the impact of that handled badly on the distribution system is extraordinary.
We're already running over short, but we want to get 2 minutes just to final. And this, we have one question from we have live. I don't know how many people, but there are, and millions. Yes. But in India, percentage-wise, that's tiny. So yeah.
You have a Luxembourg.
Yes, that's right. But one of the questions from Karthik at CEEW, Karthik Ganeshan, is the absence of an outstanding integration cost changing the risks and the risk profile. So this is where the studies that you had mentioned, I think, will go a long way. But are we seeing it that there's a nebulous risk is a generic term thrown at the discoms and so forth, but are there things that are actually more tangible that could improve, or is it just all lumped together, and is that changing the risk perception, which then obviously impacts financing? One of the questions. Very, very briefly, two points, Professor. Okay, Professor Sengupta. Yeah. Very brief.
Sitting. My problem. Since our colleague expert from CEA is here, I would like to just be educated about. I hear that there is this power exchange, and the price has crashed there because of excess power in the system, because there was oversupply of power, over creation of capacity in the past, and because of high price at that time, or in the power exchange. Now there has been overinvestment. Now that must have influenced now the kind of low price in the exchange which is prevailing. How long this would have effect on your market for, when you are doing this business about renewables? Sometimes it is being said that is influencing the current, whether something will be taken up or not. This is one question.
So if we could just limit it to one, sorry.
No, I just want another thing. You see, this transient phase, from coal to renewables, what is going to be the transitory technology? Is it that in the grid management, we have to depend substantively on, making conventional technologies more flexible? How far that would work? The ramping up and ramping down, whether that can, help in the process. I think CEA is doing some work on that. Thank you.
Last, sorry, but our colleagues will be here over lunch, so we could continue this discussion.
I'm Hippusal Krisalanathan from NIS Bangalore. My question is, between utility solar and rooftop solar, from the grid integration point of view, is the latter better because the power is generated at the demand centers? And secondly, is it time that we evaluate our discoms not by profit only, but by how many customers or rural customers they are reaching, how much renewable they are able to integrate into their mix? Those should be also the parameters to look at the discom's performance.
So I think Gagan had already mentioned these discom ratings are not just the standards and poor type of ratings. And there's a wide space for other social contract metrics as well. One of the ratings, in fact, said how much Hindi is being used in your, you know. So, you know, there's no end to some of these sort of evaluations. Responses, you know.
I think the point I'd like to make here is that the government is incentivizing the promotion of Rooftop. You may have noticed in the press about SBI's loan program for Rooftop, which is being priced at about 10-20 bips over their base rate, which is very attractive. You know, you're talking about the same rates as you have for almost housing loans. So you're talking about 8.2%, 8.3%, which is amazingly attractive. But having said that, you know, one needs to realize the reality of working in India is that our interest rates relative to global levels still high. And that's a function of the kind of economy we are. I mean, we're a scale economy with some inflationary pressures going forward. I mean, London LIBOR is 1.87%. So that's where they start. RBI's repo rate is 6%. So, you know, you're not going to make up that 4% gap ever. So there is that sort of lag. But that's a fact of life in India. You know, you can't change that. Nothing much we can do about it.
Any responses
From
to the
the,
others, or the risk
yeah.
issue of integration, or any of the questions?
Yeah, I think from the question about the utility or the rooftop, which is better in terms of grid integration, of course, I'm a banker, I'm not a technical expert, but it seems, of course, as much as you have a distributed generation capacity, it will, of course, save the central grid. But the other challenge would, of course, lie in the two-way flow of power from those distributed sources also. How the local, you know, operators are managing those two, and there seems to be some challenge about it, basis which I think.
I mean, so this is where lessons of Hawaii, Germany, and others matter. In Hawaii, I mean, there was a question, how much distributed can you handle at a transformer level? That's the unit at which it matters. One rule of thumb used to be 20%, but now places are far higher than that. If there's that it depends that you're fond of, David. If you've got a smart inverter, then you can actually feed in reactive power. You can balance a lot of these flows. So the question is more, do we have the appetite and the standards for example, mandating smart inverters, which is not there in the net metering norms today. So if you have that, then you can actually handle a lot more and maybe make it a win-win that the consumers could get paid for providing not just kilowatt hours into the grid, but non-kilowatt hour services. Now the catch is we don't have the frameworks. Why would I invest in such a thing if I'm not paid for the reactive power support or so many of the other things, the VAR, the PF, power factor correction? These are things technologically possible, but I think the markets for those haven't yet emerged. And at some point, this is how big your scale is. You will need that. So the question is India, you know, planning ahead fast enough for that?
Well, or you could imagine adjusting the incentive programs to whether the rooftop is actually providing grid support. So if you have smart inverters, you get a different incentive structure than rather than just mandating them. It's not like these smart inverters are free. The German experience is with the way they started with dumb inverters and they went to smarter inverters. It's very expensive to change that out.
But retrofitting is always expensive.
Yeah, but even in the beginning. So I guess my point is, I've already revealed my hand. I'm a big skeptic about rooftop. I think rooftop is very good for politicians and people who want to show their neighbor that they're doing the right thing by the environment, and is not actually a serious way of generating bulk power. Now, I understand the situation in India is different, especially because of local outages and so on. But, I mean, to what Navros said earlier, in an environment where the distribution system's already fragile, an environment that's pushing a lot of rooftop into that kind of environment, we really need to think about the integration issues and risks and costs. And I think we've had a lot of discussion about integration costs, and the case has been made that they're being addressed. Regulators in my country say the same thing. I remain very skeptical, and I think one of the areas you asked about, what would be new areas of work, I think one of the things that would be very important to do is to start to look closely at real integration costs as RE scales in an environment where the discoms have huge variation in their engineering integrity, in their financial viability, and so on, and then those kinds of real world circumstances. If one were to do that carefully, this is something that India would teach the rest of the world. This would be a huge contribution because everyone's just kind of talking about this right now globally, and we don't really have a good handle on what it means at scale.
So last
Just one
remarks
point
from-
on the rooftop thing, David, is that when you look at financing rooftop, you're talking about micro lending to a certain extent, and there's enough, there is sufficient empirical evidence in India that micro loans don't go as bad to the level that big loans do. So it's kind of ironic that big loans tend to go bad much worse, and much quicker than small loans. So you're looking at perhaps a business opportunity here.
So last, Vikas, wish list. I mean, suggestions, wish list.
Are we in the wish list phase of the meeting?
The last few remarks can include those. Yes.
Yeah, thanks, Rahul. I think we've discussed already all the points, where we can think about at least the next 5 years, where if not targeting the targets, but just how to manage the renewable energy integration and better utilization by the final consumers of renewable energy, which is equivalent to electricity, normal electricity that anybody has. So how to manage discoms and how to manage this additional capacity which is going to come in the next 5 years, and losing a bit of that attractiveness to the tariffs that we've already seen in this year. How best we can actually install that capacity and utilize that too. I think that should be
Get it in the system and get it offtake and both players.
Can I add one more item to your wish list? So I want to come back to this issue of emissions. This is amenable to research. In fact, lots of people have done a lot of really good research in this area all around the world. And I think it's really important we continue to zero in on what is the impact of scaling up of renewables on emissions and where that's being done with incentives. A lot of this is pure market play right now, but where it's being done with incentives, how much emissions reduction are we getting per rupee spent? Because there are a lot of ways to reduce emissions, and I feel like policymakers increasingly need guidance, or at least information, about what's cost effective. And to simply assume that under all circumstances this is the best way to reduce
Vegetarian
emissions.
diets.
Well, so vegetarian. So I'm not proposing you increase the scope of the analysis to compare renewable energy policies against the vegetarian diet, but maybe eventually.
Yeah.
But the more it scales, the more important it is to really pay attention to the cost effectiveness of the strategy compared with, changing heat rates in coal plants, changing dispatch. I do think you're going to find, no matter what happens in the gas market, you're going to find that an awful lot of coal remains at the margin, and that there are significant emissions associated with that. And so the story, that what we've learned from some of the American research in this area is the story is ironic sometimes, that emissions actually do go up. And it could be that emissions of criteria pollutants in particular go up, which is a much more urgent problem for India to witness today.
Well, thank you very much to my panelists and thank you everyone for joining us for what has provided food for thought at the very least. We do have food, so please stay for lunch. And we do have another great session coming up with not just David, but also Navroz Dubash and Samantha Gross joining us on issues of climate change. COP3 is right around the corner. Oh, sorry, 23. Sorry. It happened, sorry. Long corner. So, COP23, sorry, it's just a few days away. And please do stay for this next session if you can. Thank you for your patience and questions. Some did not get asked. I apologize to those comments, but hopefully we can continue this discussion. Thank you.